If you're looking at your tech portfolio today, wondering why valuations are randomly resetting, you're witnessing a structural rotation that hit the Nasdaq this morning. To understand the move, we have to look at the economic barometers that stopped responding to traditional triggers this week. Despite escalating military tensions and clashes near the Strait of Hormuz, the expected energy crisis failed to materialize. This chart shows the expected price spike for WTI crude. Instead of surging, prices dropped below $72, erasing the war premium. With diplomatic backchannels between Washington and Tehran active, Wall Street realized an energy shutdown was unlikely and immediately priced out the anxiety. Simultaneously, the usual triggers for debt-based panic failed to fire. Usually, massive deficit expansion leads to a scramble for buyers, yet the Treasury's critical 30-year bond auction passed with ease. Even with a yield of 5.058%, the highest since 2007, international demand exceeded the available supply, pushing the 10-year Treasury yield down to 4.53%. With oil prices stabilized and bond market panic erased, billions in institutional liquidity suddenly freed up. That cash immediately hunted down one highly specific target. That target is South Korean semiconductor manufacturer SK Hynix, which officially debuted its American depository receipts on the U.S. stock market today. At $29 billion, this is officially the largest foreign IPO in United States history. This diagram shows raw data flowing into an AI processor. High bandwidth memory, or HBM, access the bridge, allowing these massive data transfers to occur. AI models cannot run without it. Adding the market breakdown, SK Hynix controls 60. SK Hynix operates as a foundational pillar for this infrastructure. That physical monopoly generates a gravitational pull massive enough to realign Wall Street. Demand for the IPO was intense, with the listing ending up 7 times oversubscribed. But institutional liquidity is finite. To purchase billions of dollars of a brand new asset, funds have to aggressively pull capital out of their existing holdings. The primary targets for this sell-off are legacy domestic chipmakers. Companies like Micron are feeling the physical drain of capital today as their stock is sold to fund the new listing. Big money is shedding these older tech portfolios without hesitation. They are routing that exact freed capital straight into the newly listed SK Hynix ADRs. This creates a vacuum effect across the Nasdaq, draining momentum from the broader semiconductor sector in real time. Institutions are executing a ruthless rotation exclusively into the foundational hardware layers required for the multi-year rollout of AI data centers. A stabilized bond auction, a crushed oil premium, and a historic IPO are all symptoms of the exact same structural pivot. In this specific market window, the impulse to secure a stake in physical AI capacity is outweighing the impulse to hedge against geopolitical instability. This balancing scale compares traditional risk factors, like sovereign debt and oil conflicts, against the sheer weight of AI infrastructure capital. Institutional money now views raw hardware as a preferred safe haven, exceeding typical defensive postures seen during Middle Eastern escalations. The market has clearly realigned its priorities. So, are you buying into the SK Hynix debut, or are you holding your current tech bags? Drop your strategy in the comments.